In our class today, we're going to look at the structure of a company, then how a company is wound up. So under structure of a company, we'll look at the types of companies that we have. We have what we call the private limited companies, the public limited companies, the non-profit and the foreign companies. And we'll also look at the incorporation process, how a company comes to life, how a name is reserved, how we submit this memorandum of association and certificate of incorporation. Then we'll later on go to discussing how a company can be wound up. So I'll look at it in the context of our Zambian cases. So be as creative as you can, where you are able to remember. So there are two types of companies that you need to know of. We have what we call private limited companies and what we call public limited companies. By definition, a private limited company has shares that are not publicly traded on the stock exchange. So whenever a company has to be incorporated, of course, through PACRA, you have two options of either having what we call a private limited company or a public limited company. So after graduating from a sole trader who has unlimited liability to a partnership who also has unlimited liabilities, business owners become tired of having their debt to be personalized, and so they graduate to having companies that have limited liability. By limited liability, we simply mean that if a company has its own debt, we will limit the debt to what a company holds. So generally, we need to understand the general features of a limited companies. Do you remember any features of a limited company? So a limited company has the following features that you need to know before I firstly streamline them into private or public. So a limited company, number one, has what we call limited liability. Limited company has what we call limited liability. What does it mean to have limited liability? To have limited liability simply means that the shareholders who are the owners of the business have their personal assets protected from the company's debts, because the debts of the company are only limited to the shares. What you put in a company is what you pay off from the debtors. You cannot go into your private property to pay your debt. So that is a distinctive feature of a limited liability. Then they have what we call separate legal entity, which means that the company is treated as a distinct legal entity, which is separate from its owners. So if you, as the owner of a company who's a shareholder, is abusing company vehicles, the company can sue you and you may have damages. So a separate legal entity simply means that the company is its own existence. Limited companies also have components of perpetual succession, meaning the company will continue to exist even if one of the shareholders or directors may die or may change. So it has a perpetual succession, unlike where we have a sole trader dying and the business also dies. The other distinctive feature of our companies is the transferability of shares, meaning shares can be bought and sold, allowing for easy transfer of ownership. Unlike in a partnership where somebody joins and you dissolve the partnership, somebody joins or dies, you need to dissolve the partnership. Here, you can easily sell your shares at whatsoever time and moment you wish to. By the way, shares are simply a component of your ownership in a company. There's also a component of corporate veil. So this concept of corporate veil ensures that the company's legal identity is distinct from the shareholders and providing protection and autonomy. So sometimes the law will allow you lifting the veils like a curtain. So sometimes shareholders or directors would want to misbehave because they're working in the name of the company. And so under law, it is permissible for directors who were expected to behave in a director manner to be sued fiduciary, which means that you can now remove the protection that the company has in its own being and sue the directors in their personal capacity. So this is what we call a corporate veil. Corporate veil ensures that the company's legal identity is protected. The other feature is that of a registered office. So a company must have a physical registered office where official documents and legal notices can be served. Company has a minimum and maximum number. So private companies usually have a minimum of 1 member, and the maximum is determined by the Articles of Association. The other characteristics stream to the issuance of what? Share capital. So it will be stipulated how much shares have been raised. So issuance of share capital, you must understand that capital is raised in a company through issuance of shares from the shareholders. And so the company will have records of how many shares they hold and how much voting rights you have. Then we also have what we call the board of directors, which is a company managed by a board of directors. So these board of directors are elected by the shareholders who will be responsible for making decisions on behalf of the company. So remember what we discussed the previous time, the agency relationship. So shareholders may not have the expertise or the know-how of how to run the business. They will elect a board of directors that will do the day-to-day running of the business, which is called the board of directors. We also have issues of annual general meetings, AGMs, where companies are required to hold AGMs where the financial statements are presented. So here directors are appointed, shareholders will raise their concerns, how are our dividends distributed. So a return on a share is called a dividend. So in the AGMs, shareholders will have concerns. By the way, there are 2 types of shareholders. We have the preference shareholders and ordinary shareholders. So these 2 types of shareholders, we'll discuss them later on so that you know what rights each one of them have. Now, companies also have a statutory reporting order where they are allowed to submit their financial statements. Unlike other types of businesses, this one's a requirement that they need to publish their what? Financial statements in the press. For public limited, of course. For private, they're not required to publish them. But for public, the public must know. There's also a statutory compliance. Companies must comply with the law. In Zambia, we have Cap 388 of the laws of Zambia, which stipulates or talks about company law. They need to also comply to tax laws and other relevant regulations in that particular country. Companies also have creditor protection. We have different types of creditors. We have secured and unsecured. So limited liability structure will protect the creditors by limiting the shareholders' liability to the amount they invested. We also have audit requirements where larger companies are required to undergo regular audits by independent auditors to ensure that they use financial transparency. Companies will also be subjected to regulation and oversight. Here, companies are subjected to regulatory oversight by the government. Authorities like the Registrar of Companies will ensure that they comply with the available requirements. Okay. Now I talked about the types of shareholders that we have. Which types of shareholders do we have in these companies?
You mentioned something like preferential shareholders.
Yes. So we have preferred shareholders and ordinary shareholders. Okay. So we have preferred shareholders and ordinary shareholders. So before I go in depth, who is a shareholder?
It is a person that owns a certain percentage of a company.
Yes. So a shareholder is a person who owns, in terms of shares, a certain percentage of a company. And what do we call the return on a share?
Dividends.
Dividend, correct. So we have two main types of shareholders. We have what we call the ordinary shareholders or common stockholders. These ones have the following characteristics. Number one, they have what? So ordinary shareholders are the only shareholders who have the real ownership of a company because they have the rights to vote on matters like electing the board of directors. Significant corporate decisions have to pass through the ordinary shareholders. So this gives them a larger say. So the shareholders claim the residue on the assets. So after the preferential shareholders have been paid, it is a common custom that shareholders are paid last. So in an event of liquidation, common stockholders have the residue claim after all the debts have been what? Paid to the debtors. The preferred stockholders are satisfied, then the remainder is what goes to the shareholders are paid last. Dividend participation. So in terms of dividend participation, common stockholders are entitled to receive a dividend, which is paid out of company's profits. So the dividends represent a share of the company's success in terms of profits. In terms of risk and reward, common stockholders will bear a higher risk compared to preferential shareholders. Because preferential shareholders aren't really real owners of the business. These ones usually are speculative investors. They just want to make a return and go. But the real owners of the business are the common stockholders because they are the actual owners. They will allow the preferential shareholders to get their benefit first. Are we together? Any questions so far? Are you following?
Yes.
Okay. So we go to the other characteristics of the common stockholders. Limited liability. So shareholders enjoy what we call limited liability, meaning their personal assets are now safe, are protected from the company's debts. So this encourages people to invest by minimizing the risk of their personal wealth. So sometimes decisions that are made in a company will lead to a loss. Okay, the other characteristic is that of information rights, preemptive rights, and market value impact. So read through this briefly. That's fine. Get the chat. Okay, so we have information rights. So common stockholders have the right to receive the relevant information about the company, like the financial statements, how are we performing, because they want to know what the interest is in terms of dividends. They also have the right to notices in their meetings. So this fosters transparency and trust in decision making. They also have what we call preemptive rights. In some jurisdictions, shareholders may have preemptive rights, which allows them to purchase additional shares before new shares are offered. So each time a company is growing, they issue new shares. And the first people to be prioritized are the indigenous ordinary shareholders. So it helps the common stockholders become the first ones to want to have a huge proportion of shareholding before the market is allowed. Market value impact, the value of the common stock is influenced by the market dynamics. So a company will grow in due time, and these will impact the growth of their shareholders. So we also have the component of convertible securities. What are convertible securities? So convertible securities are options that are given where shareholders will be allowed to convert their shares into another class of securities like preferential shares or debt, or vice versa. You can want to upgrade your shareholders into another form. So it provides flexibility for the potential for increased shareholder value. And finally, control and governance. So common stockholders right to exercise control through voting. So these ones are the main importance of the company. So this topic, one which is vital for you, is the corporate law, corporate governance. We need to understand how a company operates. Then we talk about the other types of shareholders, what they want. Preferential shareholders. So preferential shareholders, like I said, are also called prior debt or speculative investors. They have no main interest of the company at heart. Of course, we have different types of preferential shareholders. We have fixed dividend payments. So the preferential shareholders are entitled to a fixed dividend. So basically, we have two guys here. One is an ordinary shareholder, one is a preferential. So preferential shareholders usually have a fixed amount, for instance, 8%. Every year they get the 8% to their first. It doesn't change, it's the same percentage. So the advantage is that it provides a stable income for them, attracting them of income focused investors. So they are focused on the income, them with our money in. The second characteristic about them is that they have priority in asset distribution. So when the dividends are declared, these ones are given priority. So in the event of a liquidation, preferential shareholders are the ones that are paid first. All right, before the common stockholders are paid. So this will enhance the security of the investment. They'll be encouraged, okay, I'll be. Because sometimes it happens that the money finishes with the preferential shareholders before even paying the common stockholders, but these ones are paid first. So the characteristic of these ones also is on the limited voting rights. So preferential shareholders have limited or no voting rights at all in comparison with common stockholders. So this allows control only on the common stockholders while providing preferential shareholders with financial benefits only. All right, so it's another characteristic that they have. So the other characteristics that we have in terms of these types of shareholders is on the dividend payments. So dividends to preferred stockholders paid before common stockholders to ensure that these ones receive their due share. So we have two types of preferential shareholders. We have what we call cumulative and non-cumulative. So cumulative are simply preferred shareholders who, in the bad year, it means they accumulate what they did not get paid the following year. So they have an advantage of topping up on what they lost out, but non-cumulative, they don't carry forward what they lost. So you can choose the consequences that it affects the payment obligations that the company has based on what type of preferential shareholder you are. So we also have what we call redemption rights. So the characteristic of this is that preferential shareholders may have what redemption features, which will allow the issuer to repurchase shares at a predetermined price. So it will offer flexibility for companies managing capital to allow people to buy shares at a reduced price for a future date. So we also have convertible or exchangeable features where preferential shareholders may convert into common stockholders if they want, or exchange for other securities like bonds or debentures. So the significance is that it provides preferential shareholders the potential for capital appreciation. So when somebody feels, okay, I now need to have voting rights, I will now convert my types of shares into ordinary shareholders. I'll become an ordinary shareholder. Okay. So lastly, we'll discuss it in terms of the participation and liquidation. So these are the components or the types of the shareholders. So in terms of participation, we know that these ones participate in surplus profits after the payments have been done to common stockholders. So some preferred shares will participate also in surplus profits. So what happens is the first people to be paid are the preferential shareholders, then the remainder goes to the ordinary shareholders. But if there's another money remaining, the surplus will be given to the preferential shareholders. Then we also have what we call the call provisions or redemption provisions, where here the issuer has a right to redeem preferred share after a specified period of time. So it will allow the issuer to manage the capital structure and liabilities. They also have seniority in liquidation. I've mentioned this. So the preferred shareholders are senior when it comes to payments before the ordinary shareholders are given. So it will give safety on the investment. So it's important to understand the characteristics of the ordinary shareholders and the preferred shareholders in the context of running a business. Okay. Any questions so far?
You can pause the recording.
All right.